Now, Goldman Sachs will pay up to $2.25 billion in cash and equity for NEOS investments and issuer. The consideration is tied to performance and service earnouts, and the transaction is expected to close in the first quarter of 2027, subject to regulatory sign-off and a fund shareholder proxy on a new advisory agreement and a trustee slate. Founders Troy and Garrett joined Goldman Sachs Asset Management as partners. Barclays advised NEOS, with Ropes and Gray as the counsel. Now, this is the second such purchase in a year. In April, Goldman closed a roughly $2 billion acquisition of Innovative Capital Management, the defined outcome and buffer ETF specialist. Together, the two deals more than triple Goldman's ETF assets and lift the combined platform to about $130 billion in ETFs, roughly $80 billion of it actively managed, enough to rank Goldman the 8th largest active ETF manager. On August 12th, Goldman Sachs agreed to pay up to $2.25 billion for NEOS Investments, a 3-year-old issuer of options income ETFs. Now read this as a product story wherein Wall Street is chasing boomer candy retirees can't resist. And this story is an unremarkable one. However, read it as a manufacturing story and it has more important moves. Goldman Sachs is buying a machine that converts an aging, cash-heavy investor base into equity-adjusted exposure and bolting it onto its own distribution. The questions worth asking here are not about the product, but about the factory, the raw materials that it runs on, and what marketed yield actually costs. Hello everyone, welcome back to our channel and welcome back to another episode of Capital Insights series. This series sits within our Fundamentals Through the Noise series here at Punjab Capital Research. And today we are going to focus on Goldman's option income roll-up and the cash to equity conversion trade. Essentially, we are talking about Goldman Sachs buying NEOS Investments for $2.25 billion. Let's first start with the deal beneath the boomer candy headline. Now, Goldman Sachs will pay up to $2.25 billion in cash and equity for NEOS Investments, an issuer that has gathered up to $30 billion from across 19 options-based income ETFs in about 3 years. The consideration is tied to performance and service earnouts, and the transaction is expected to close in the first quarter of 2027, subject to regulatory sign-off and a fund shareholder proxy on a new advisory agreement and a trustee slate. Founders Troy and Garrett joined Goldman Sachs Asset Management as partners. Barclays advised NEOS, with Ropes and Gray as the counsel. Now, this is the second such purchase in a year. In April, Goldman closed a roughly $2 billion acquisition of Innovative Capital Management, the defined outcome and buffer ETF specialist. Together, the two deals more than triple Goldman's ETF assets and lift the combined platform to about $130 billion in ETFs, roughly $80 billion of it actively managed, enough to rank Goldman the 8th largest active ETF manager. So what's important about this deal? The framing tell is in the language out here. David Solomon described NEOS as adding durable revenue and a diverse toolkit for different market environments. This is not a product bet, it is a fee revenue diversification. Asset and wealth management produced $4.6 billion of net revenue in the second quarter, up 20% year over year. The recurring fee-based income that offset the volatility of banking and trading. Now read this correctly. The acquisition is a manufacturing and distribution roll-up, and the retail-facing boomer candy narrative is the least interesting thing about it. And that's why this leads us to the discussion of $3 trillion cash pile in search of a conversion path. Every factory needs raw material, and this one runs on cash on the sidelines. Retail money market funds hold north of $3 trillion, hovering near record highs, and much of the demographic capital that migrated to cash as its owners approached retirement. And the strategic problem that these products solve is not really an investing problem, it's an asset gathering problem. How do you pry the balance of the sidelines without asking it to accept the full drawdown risk of equities? Manufactured yield is the bridge, and that reframes the entire category. These are not equity substitutes, they are cash conversion mechanisms. The pitch that an advisor makes, better than money market fund after tax, with a buffer against a drawdown that would derail a retirement. And this pitch is engineered to convert money market balances and not to beat the index. Morningstar puts the combined derivative income and defined outcome market at roughly $180 billion, compounding at about 70% in a year. The demographic tailwind is not a footnote to the thesis, it is the entire thesis. So essentially, the pitch is engineered to convert money market balances, not beat the index. And these are cash conversion mechanisms wearing the costume of equity funds. And this leads us to the income, buffer, and the edge case of manufactured crypto yield. Two product families sit under one roof. The income line, Neo Specialty, sells option premium, call spreads written against an index to manufacture a high monthly distribution while retaining portion upside. And the flagship SPY targets a distribution rate near 12%. The buffer managed outcome line, Innovator Specialty, offers an explicit downside buffer over a defined period in exchange for a hard cap on gains. Put together, the buffer plus managed outcome plus income is the complete defined outcome shelf, the toolkit for every market environment an advisor can allocate across. That completeness is the strategic point. The instructive case here is BTCI, Neo's Bitcoin High Income Fund. It does not hold Bitcoin directly. It is a fund of funds that writes calls against Bitcoin exposure to spin off a distribution rate near 47%. It's the same machine. Sell volatility, manufacture yield, cap the upside. Pointed at the single most volatile underlying available. Now hold it as a control experiment. If the mechanism has a hidden cost, the most volatile version of it is where that cost shows up in full. And this brings us to the teardown. The distribution rate is not the total return. Now this is the whole piece in one sentence. The distribution rate is a payout ratio, not a return. The two diverge by design, and the marketing leans entirely on the first while the investor lives on the second. Take SPY, the flagship. It markets a distribution rate around 12% paid monthly. Yet, from its inception in August 2022 through mid-2026, a $10,000 investment with distributions reinvested grew to roughly $17,300, against a roughly $20,000 for the S&P 500 total return index over the same time span. The strategy captured about 3/4 of the index total return while advertising a double-digit yield. And a substantial share of that payout is classified as return on capital, option premium, and at times the investor's own principal handed back, not economic income in the fixed income sense. The gap is not a defect, it is the trade. You are selling the right tail of the return distribution for a smoother, front-loaded cash stream, and in a rising market you underperform by construction. Now, BTCI is the same trade with the volume turned up, and it is merciless. A distribution rate near 27% sat alongside a one-year total return of near minus 40%, and since inception compound, that is slightly negative. The covered calls cap every rally in the underlying, the drawdowns passed through in full, and the eye-catching yield was substantially the investor's own capital returned on a shrinking base. The distribution rate told you nothing about what you earned, which is precisely the point. Priced as volatility harvesting and payout timing vehicles, these funds have a legitimate place. Priced off as headline distribution rate, they are a trap. And this brings us to why Goldman buys the factory instead of the fund. There are three reasons that explain why an incumbent pays a premium to own the manufacturer rather than build a competing product. First and foremost, the margin capture. Goldman already owns the advisor and the wealth channel, so owning the product removes the sub-advisor leak and captures the full stack. Neo has gathered $30 billion in 3 years by selling a simple pitch to yield-hungry advisors, and Goldman's distribution can scale that further. Secondly, we have revenue durability. Options income AUM is sticky and fee-rich. SPY runs nearly 0.68% and BTCI near 0.99% against a handful of basis points for plain index fund. And it's exactly the recurring fee income that steadies a franchise whipsawed by banking and trading cycles. Thirdly, the speed. 2 acquisitions more than tripled Goldman's ETF book. Building organic share in a category compounding at 70% would be far slower than buying the incumbents. For the allocators, the pattern is a recognizable one from across the asset management complex. Scale the platforms, acquiring capability and distribution adjacency, not merely the assets. Expect more of it while the category compounds, and expect the specialist founders who build these franchises to keep exiting into balance sheets that can distribute them. Let's also focus on the thickening short volatility layer. Now zoom out, and every one of these funds is structurally short volatility. 180 billion category growing at 70% is a rapidly thickening layer of programmatic option selling supply, and that has 2 consequences worth watching. In calm regimes, persistent mechanical call selling is a steady offer and volatility that can suppress realized volume, flattering the strategy's own risk-adjusted numbers and inviting further inflows, a reflexive loop. But the same positioning that dampens moves in quiet markets can amplify them when the regime breaks and the hedging flows reverse. A category this large and this concentrated in a single structural trade is a variable to monitor even when it is not yet systemic. There is also a sell side story out here. The ETF wrapper is commoditizing what private banks long sold as structured notes: cheaper, more liquid, more transparent. That is good for the end investor and a margin compression event for the note desk. The manufacturing is migrating from bespoke, high margin notes to scaled, low cost funds, which is exactly why the incumbent will rather own the factory than keep structuring the notes. In wrap up, we can say that Boltzmann bet is that the demographic wall of cash keeps the factory running for years. That is probably right, but the growth of the manufacturer is not the same as the value of the product, and separating the two is the entire exercise. The distribution rate is the noise out here. The total return, net of the capped upside and returned capital, is the fundamental, and that's what we want to focus on: fundamental through the noise. And for the allocators, street test should precede any allocation. Firstly, judge total return net of everything against the underlying, never the distribution rate. Secondly, ask what the return of capital composition of payout actually is. And thirdly, identify which market regime the cap or the buffer is priced for and whether that matches your view. That's all that we wanted to share with you on this episode of Capital Insights. Stay tuned in for our next one.